You told me before we started filming about a buyer who almost lost her deal 10 days before the end. Tell me that story.
Yeah, so the appraisal came in $18,000 below value. She'd been saving for 6 years, thought it was over. It wasn't. But that outcome, the one where she actually closes, that only happened because she understood the process before she was in it. Most buyers don't get that briefing, and it can cost them.
Let's tell that full story. Walk us through what happened.
Yeah, so she'd been running for 6 years, saving the whole time. She had strong income, good credit, and a substantial down payment. By every measure, she was a strong buyer. Got pre-approved without any issues, found a home she loved in her target neighborhood, went under contract, and about 2 weeks in, the appraisal came back. The appraiser valued the property at $18,000 below the purchase price, which means her lender would only finance based on the appraised value, not the contract price. You see, most buyers will freeze at that point. They don't know what their options are, they panic, and the transaction either stalls or falls apart. She didn't freeze because 2 months before she ever found that property, we had that 20-minute conversation about exactly this scenario. What an appraisal gap is, what the options are, and what she can do if it happened. So we went back to the seller with the appraisal, negotiated a $12,000 price reduction, and she covered the remaining $6,000 gap. So both parties split, the deal held, and she was in her home on the original timeline. The difference wasn't the appraisal, the difference was the preparation.
What's the biggest misconception buyers have once they're pre-approved?
Yeah, that pre-approved means approved. It doesn't. Pre-approval is a conditional assessment based on your financial picture at one specific moment in time. The lender looks at your income, your credit, your assets, and they say, hey, based on what I'm seeing today, you qualify for this amount. It's a green light to go shopping, but it's not a guarantee that the loan will fund. And the reason why is because between pre-approval and funding, a lot can happen. And lenders re-verify everything at the back end. What was true when you applied has to still be true when the loan funds. And I've had buyer open up new credit cards to buy furniture for the house they were about to move into. One card, it changed their debt to income ratio enough to put the loan at risk. I've had buyers change jobs between pre-approval and closing, even for significantly more money, and it triggered a full re-underwrite because the income documentation changed. You see, these aren't edge cases. These happen regularly, and they happen because nobody told the buyer what the rules were.
So what actually happens between going under contract and funding? Walk us through the stages.
Well, yeah, there's 4 main stages, and each one has its own failure point. Stage 1 is the appraisal. Once you're under contract, the lender orders an appraisal to confirm the property is worth what you're paying. If it comes in low, you have 3 options. The seller reduces the price, you cover the gap in cash, or you walk away. You, of course, can negotiate something in between like the prior example, but that's pretty much it. There are no other paths. Stage 2 is underwriting. The underwriter does a full re-verification of your income, employment, and assets. Every W-2, every pay stub, every bank account gets reviewed again. Large, unexplained deposits get flagged. New debt that appeared since pre-approval shows up. A job change has to be redocumented. This is where a lot of buyers get surprised. Stage 3 is title. A title search runs in parallel, making sure there are no liens, unpaid taxes, ownership disputes, or encumbrances on the property. Title issues have nothing to do with your finances, but they can delay or kill a deal even when everything on your side looks perfect. And then stage 4 is the closing disclosure. 3 business days before you fund, you receive a document that shows every dollar involved in the transaction. Your loan amount, interest rate, all the fees, everything. You're going to want to review it carefully, and if something changed from your original estimate, you have the right to understand why. Each of these is manageable, but only if you know it's coming.
What are the less obvious things that trip buyers up in this phase, the ones they don't see coming?
Well, there's 3 that come up more than people expect. Number 1 is rate lock expiration. When you lock a rate, you lock it for a specific window. typically 30 to 45 days. If the transaction gets delayed for any reason and your lock expires, you either pay to extend it or you relock at whatever the current rate is. In a rising rate environment, that can be a meaningful number. Number two is HOA issues. If you're buying a condo or a home in an HOA, the lender has to review the association's financials as part of the approval. So if the HOA is underfunded, it has a high delinquency rate, or if it's involved in active litigation, the loan may not be approved for that specific property, regardless of how strong your personal profile is. So you can be perfect borrower and still be denied the loan because of the HOA. And the third one is last-minute employment verification. Most lenders do a verbal verification of employment within about 10 days of funding. Your employer gets a call to confirm you're still employed in the same role. If something changed, even a title change, even a shift in hours, it could potentially go back to underwriting. So none of these are reasons not to buy. They are reasons to be informed before you're in the middle of one.
What's the single most costly thing buyers do in this phase that they later regret?
It's really making financial moves without telling their lender first. Any change in your financial picture between pre-approval and funding needs to be disclosed, whether that's new credit card account, new debt, job change, even large deposits into your account, a gift from a family member towards a down payment, moving money between accounts. All of these things matter. These aren't gotchas. They're things underwriters are required to document and explain. The buyers who get tripped up are the ones who thought it's just a small thing and that it won't matter, but it often does matter. The rule is simple and it works every time. Before you do anything financial between pre-approval and funding, call your lender first. It's just a 30-second call, and that call has saved a lot of transactions.
For a buyer who is in the process right now, what are the 3 things they should do?
Well, I'd say first, ask your lender for a process timeline. Just a one-page document that shows every milestone, every document requested, every deadline from contract to funding. If your lender doesn't give you this automatically, ask for it. You should know what's coming before it arrives. Second, don't touch your finances. No new credit accounts, no large purchases, no significant deposits you can't document with a paper trail, no job changes without telling your lender first. Just hold everything steady until the loan funds. And third, respond same day. Every time your underwriter asks for something, your agent asks for something, your title company asks for something, respond that day. The number one controllable cause of delayed fundings is a buyer who went quiet. Don't be that buyer.
And if someone wants to work with you and get that briefing up front, how do they find you?
You can schedule a free 15-minute call at teamaronheim.com. One of the first things I do with every buyer before they ever find a property is walk through exactly this process. What's coming, what to avoid, and how to set up the transaction so nothing surprises you. You pick the time, we get it done, or you can text me at 720-200-5464. The buyers have the smoothest experience are the ones who understand the process before they start it. That briefing is free. Let's do it now.